Hello, I'm Rebecca, the founder of triiyo. triiyo uses technology to enable organisations to prioritise the employee experience during every work-life transition that occurs in the workplace. And welcome to PEP Talks with triiyo, where our expert partners share advice and discuss the workplace transitions that matter to you. Keep listening as we connect the dots between what's happening in life and work with the simple aim of education and empowerment, all because life happens at work. Now, financial well-being is an area of great need at the moment with the changing landscape and rising costs of living. So today we've partnered with one of our financial well-being experts, Darren Smith, Managing Director of Financial Wellness Matters Group. Darren, welcome. Thank you for being here.
Thank you for having me. It's great.
Pleasure. Would you like to tell us a little bit about yourself and the work you do at Financial Matters Group?
Yeah, sure. Well, I'm lucky enough to be Managing Director of Financial Wellness Matters and a connected advice company. Look after a team of 35 people. So our job, which fits really well with the triiyo relationship, is helping people through transitions and helping them achieve what's important. So we work with organisations and we help individuals one-on-one on basically how they can make the most of their money and hopefully reduce a little bit of stress along the way.
Absolutely. And you're right. You've hit the topic there in terms of, when we do have life events, life stages, life transitions, invariably it touches on finances, whether we're having a baby all the way through to planning our retirement. The inflation is, going through the roof at the moment. Many people are concerned about their finances. What are you seeing are the topics that are in demand? What are people concerned about? And what are you telling people? What can they do about what's happening in the financial landscape at the moment?
Yeah, it's a great question, and obviously everyone wants the answer, and it's probably different for everyone. I think that's probably the first thing that when we talk to people or that's coming out of the conversations is understand what's important to you and do the work on knowing what's really important. If you do that, that sort of helps with a lot of the money decisions and trade-offs. But generally with things rising at a rate of knots, and it probably depends on where you're at in your life stage or your career, but ultimately people are looking for ways to save. So a lot of the topics or questions we're getting at, how can I practically get a little bit of control back? Because there's lots I can't control, but the bits I can are around where am I spending my money? Is there ways to save? If I've got a home loan or I have debt, how do I best manage that? So can I have a conversation with the bank and get a reduced interest rate, even though interest rates are rising? The short answer is yes, you can. And so it's generally around helping people get back in control and have the confidence to at least take a next step. I suppose our advice or our general guidance would be invest a bit of time and focus on it. And again, try not take on too much in one go. Little bite-sized chunks is the best way to deal with it. Get a bit of confidence and then move on to the next one.
Great. Now, one of the sort of big transitions that people at triiyo are on is obviously having a family and starting a family and having babies. And invariably that requires one parent to be out of the workforce for a period of time. I would imagine at this point in time, there are people sort of considering, can I afford to take 12 months off? Maybe I need to reduce it to 6 months. When you're out of work, you're not contributing to your super, although some organisations, but very few, will still pay super during parental leave. What can families do? Are there options for the partner that remains in the workplace to increase their super repayments? Because super becomes a family asset, I guess, over over a period of time. What do we sort of look at reducing the time we take off? Do we look at pausing our mortgage repayments? Do we pay off debt before we start? What are the practical things that people can do if they're entering that phase of life?
Yeah, absolutely. And as you say, it's a common situation for people to be trying to deal through that transition. And I think sometimes it's planned and sometimes it's not so planned. Either way, I think it's really important, again, to get back to the basics of if you understand your current financial position before you move into that transition, that's a really good place to start. Write it down on a bit of paper. It doesn't have to be too complicated, but really understand what you own, what you owe, what interest rates there are, and where the income is coming in. So understanding your income, and then also understanding where the spending's going. And I think the reason we'd say take the time to understand where your spending is, you can at least make those decisions about what can you stop, what can you slow down, what can you defer. And to your point, Rebecca, I think some organisations are really supportive, and you can get support throughout that, which might help you keep contributing to super. But it also gives you the opportunity, one, to engage your employer and have that conversation. But I'd say it's then going through all your different big expenses and saying, all right, well, do we really need this during this time, or can we reprioritise? And I suppose that's the whole reassessment of what's important to you right now. Because I think what most people find in that transition is, while some expenses stop, there's a whole range of other expenses that come up that you've got to deal with. So again, having a clear picture of what it is puts you in control to make the decisions. I think on the income side, some families look at, well, is there another way to generate some short-term income while I am home that might just offset, or is there government allowances that I might be able to tap into during that time and support? And I think it's, again, getting where there is both couple or a couple, where there's two people involved, then it's everyone understanding how they can contribute during that period. But you really do need to understand your starting position so you can then make the adjustments either to income or to where your spending's going. But it definitely is a changing scenario. And I think the other thing you raise is, how long do you expect to be off, and what's your buffer or backup plan if that ends up being a little bit longer, if things don't go quite to plan. So a lot to think about, but practically, I think put yourself back in control by understanding the numbers at a high level, and then dig down into the spending and work out where you can save.
Yeah.
Is a good start.
Yeah. I mean, going down to becoming a one income family for a period of time is challenging for most people.
Definitely.
And if we have mortgages at that same time frame, would you say if people are aware that they're going to fall out of their sort of fixed period with a mortgage during the time that they've dropped into becoming a one income family?
Yeah.
With the concerns around the rising interest rates, would it be sensible to look at refinancing or remortgaging sooner rather than later to know what your outgoings are going to be and fix those during the period that you may be down to one income? Yeah.
So really good question, and it does depend on each person's own individual circumstances. So if I talk generally, I think you'd want to understand certainty is important to some people during that time. So the benefit for some of taking a fixed rate interest rate might be that it gives certainty, or it might be part of the loan that's fixed to give more certainty. I'd also have a look at, because managing money well is about behaviours and money. And again, if you can get into the good habits, so if you're paying more than the required mortgage at the moment, you've really got to make that call. Do you lower that a little bit to make it a little bit easier during that transition? But then what's your plan? What's your backup? Are you, when you come back to work, are you going to put those repayments back up? So I think it depends on the family situation or your individual situation. But what I'd say is it's a good chance for you to go to your bank, have a look at where your repayments are at. One, whether you can negotiate a little bit better deal without telling them all your details. But certainly the whole question of fixed, not fixed, depends on your own situation. But what's happened now with interest rates, getting a fixed rate is still pretty expensive. You're probably paying 1 or 2% above what the current variable rate is. So again, it depends what time are you going to be off from work. But yeah, definitely the changing landscape, increasing interest rates is here with us for at least the next couple of years. And most are predicting, I think the 2-year fixed rate at the moment has definitely got a 5 in it. In some cases, their predictions, it might be a little bit higher than that. But at the moment, it's high 4s, early 5s at the moment for a 2-year fixed rate.
Okay.
So it sort of gives you a sense of where banks think interest rates are going to be.
Yeah. And debt used to be obviously very cheap, right? So, you know, it was easy to get credit and to get into debt.
Yep.
With the changing landscape now, does it make sense to look to pay off that debt or refinance? What would be your advice there?
Yeah. So again, I'll talk generally because I don't know people's
Appreciate
individual
none of this is financial advice.
None of this is personal advice, but I think refinancing is very difficult right now for anyone, even whether you're not going through this transition. The requirements have gone up a level in terms of what they want to know about your income and expenses, and particularly if you're going to have a change in income, that may impact your ability to get that refinanced.
So organise this before that happens.
Yeah, absolutely. And you know, when from an interest of disclosure, you do really have to let them know if there are major changes happening. You know, obviously some people will and some people won't, but I think ultimately your best bet would be understand what the best you can do with your existing bank or your existing debt first. And you've probably got more flexibility, particularly if you're ahead of payments or you've got more ability to go and get, I suppose, the ability for them to vary it a little bit to make it a bit easier, be it for a short period. In extreme situations, the bank may give a bit of leeway in terms of really lowering that repayment to interest only for a short period. That can help people in terms of cash flow if that's really a problem. But what I would say is if you can, try and keep your repayments at least what you're already doing if you can, because unfortunately Australians are notorious for once you go down, it's very hard to go back up because we readjust our lifestyle and our spending to suit. But definitely if it's family, having a family, that's one that you've got a fair idea on controlling the time, providing everything goes to plan. So yeah, we definitely see people fixing part of their loan or reducing the repayments for a set period, just to ease some of that pressure. And they would tend to put the surplus money in a safety buffer account and not use that unless they really have to.
Yeah. And what about sort of financial hygiene? You know, when, you know, if we're sort of thinking we need to look at our, you know, financial landscape, what can individuals do just to sort of have a bit of a hygiene check on where am I? You know, a lot of us bury our head in the sands. I certainly don't understand finances at all. So it's one of those things that I just bury my head and, you know, really only deal with it when I absolutely have to. Yeah. What would your tips be around, you know, how can we have a bit of a hygiene check on where we're at? What do we need to do?
Yeah, I think it gets back to some basics. You do have to invest a little bit of time, and I know it can be painful or a strange experience for some people, and we probably take for granted because we're just used to doing it.
Do it every day. It's easy.
Yeah. So it's sort of getting the balance right between, I think, putting down your spending into a spreadsheet, and we can access those with people that we work with, or there's plenty available on some of the government websites, like Money Smart is a really good website. So there's plenty of apps and tools that can help you get the basics down. And I think at least part of that hygiene piece is it's a look in the mirror piece of saying, well, this is at least my current position. And if I can do that, and yes, it will take some time, but you don't have to revisit every week or every month necessarily. Again, we always say a 3-monthly check is as good as, it's much better than not doing the check. So I think some people get wrapped up and think that every week they're going to have to spend a lot of time around the money. Once you get the broad structure in place, it just needs a review and monitoring for changes in conditions or your situation. So once you get people on a path, it's pretty self-maintaining with a little bit of effort. But yeah, I know it can be painful, definitely setting up. But I'd say at least understand on a bit of paper what you owe and what you own, and what interest rate, for example, that you're currently paying, because there's always an opportunity in most cases to go back to your bank and say, hey, can I get a little bit off this? And if that's $1,000 a year, that could be really meaningful to a family.
Yeah. That's great advice. And I guess part of that, what do I owe? What do I own? It's looking at that budget as well, and looking at that, what buffer do I have and where
Yeah.
can I cut costs? Is there, from a savings perspective, is there sort of a rule of thumb that individuals should look at, from my monthly income?
Yeah.
As a best practice, this is what I should be setting aside into a savings account?
Yeah. Good question. Again, it depends on everyone's circumstances. But look, I suppose when we do our work around budgeting with groups or individuals, we tend to say the default should be 50% is around your fixed known expenses. And that's sort of 50% of whatever you earn probably should be going towards those things, or will have to. There's then 25% that goes to, I'll call it the fun stuff or the optional stuff. Because if you don't do that stuff, you won't stick to a budget, you won't stick to a plan. And then it's having that remaining sort of 25% going towards the future. And that future could be saving for the unexpected, it could be investing, it could be topping up your superannuation, etc., depending on your goals. But the ideal scenario would be 50% of your spending for most people going towards the have to spends. 25% to the variable, the optional, the fun, we call that. But
we
the
need
future
to have fun.
The trouble for us, or for the people that quite often we are trying to help, is fun extends into the future and absorbs everything of the future. So the fix we can't really change, but the fun merges into the future, and it's probably just trying to get the balance. And I always take my own rule is, if I have a windfall, a third always goes towards paying off debt. No matter what amount it is, it's just a rule that we apply. And it's just habit now. And I suppose that's working out what's the way you interact with money, and what works for you. So we have people who put money in glass jars. We have people who put money in envelopes. We have people who have 20 bank accounts. I'm not suggesting any one of those is right or wrong. It's finding out what works for you. And as long as you can put something aside for the rainy day, it's pretty important.
Yeah. And finally, do you sort of talk to people through things like insurances and wills and life insurance? And, again, as you sort of get older and you're starting families and you're going through life, when you're young, we don't tend to, I never did anyway, sort of think about these things. But is that something that you talk to people about and, help people set up? Because actually these things do happen, and it really does come to a point in our life where we need to make sure that we are protected, our partners and our families are protected. And as horrible as those conversations are, they do need to be had.
Most definitely. I think there's two parts, as you're aware, to our business. One is where we do general information around those topics. Then there's another part of our business that deals with individual advice that's personalised and regulated, etc. But we work with a lot of professional partners, lawyers, estate planners, etc. So again, if anyone wants to reach out, we've got some tools that we can share around general steps you can take. But it is really important, regardless of age. And when we're talking to the younger part of the workforce, and I put myself in the more mature part of the workforce in terms of age, with super these days, most people through their insurance through work have insurance. So again, if you haven't got a will or an estate that's up to date, and a fairly big percentage of people don't, that's not going to go. If anything does happen, the unfortunate, well, what happens with the super money and the insurance that you've put in place? Do you want it to go to the place that you want it to go to? The best way to do that is to have a plan and have it reviewed by a professional, definitely. So I think a lot of these things you don't have to do yourself. Sometimes it does cost money, but there's a lot of general information. I go back and say one great website that is free is the Money Smart website, which is designed and done by the government. It's got lots of useful calculators and tips for pretty much every topic around finance. And again, obviously, there's ways to reach out to us or people like us.
Yeah, with that, I only looked at those things when I was having my child. But actually what you're saying is really we should be looking at that when we start work. We've got, we're having money going into a super. at that point, we should actually start thinking about, what happened, where does this happen? Let's set it up at this point, and then sporadically we can review it. But actually don't wait until, I sort of did it because I felt like I had responsibilities finally. And, I needed to get these things in place. But actually what you're saying is, it's actually a good thing to do early on in your career.
I think absolutely. It's identifying what are the most important things, but having an appreciation of some things might be more important now, but at least understand how you plan to deal with those other things. So there's insurance that might come by your employer, and superannuation plans connected to that employer, but you might have insurance outside of that as well. And most people would prioritise that a bit later, but the later you leave it, the more expensive it becomes. So it's one of those things of just getting into good money habits, and I think try and keep it as simple as possible also helps.
Amazing. Thank you so much, Darren. It's been wonderful talking to you. It's certainly a hot topic at the moment, and I do appreciate that this is general advice, but it's really just opening people's eyes to what can I think about? What do I need to think about? What are the potential options that I have to me? And really what I'm hearing is, let's start the conversation, because the sooner we start the conversation, the sooner we're going to have more control over our financial security as we go through these transitions, and as we can manage life as it throws things at us. So it's amazing. Thank you so much. I look forward to talking to you again.
Definitely.
Thank you for your time.
Thanks for the opportunity. Really appreciate it.
Speak soon.